Hi, this is Ameya from FinQuest Institute. In this video, we'll introduce ourselves to bond markets. These are a few points which will be discussed as a part of this video. We'll start with capital markets. So these are financial markets in the country. Now they are a very close part of the economy. So they are deeply integrated. So things which happen in the economy are reflected in the movements in the financial markets. They provide an avenue for market participants to do a variety of activities. So it could be trading, it could be investments, or it could be borrowing of funds. So let's look at a few purposes which capital markets are supporting. Firstly, matching of demand and supply of funds. Now we know that in the market, participants are holding different kinds of fund positions. So one of the participants may have excess funds, other participant may be short of funds. So, so here we see that there is a mismatch in funds. Now this is required because if everyone has a specific level of funding available with them, then that is not going to allow any kind of transactions in the market. So this kind of imbalance allows trades to happen, and capital market provides an avenue for matching of demand and supply of funds. Then mobilizing savings and investments for households and institutions. It's a very important input for any capital market because finally the money which individuals and institutions are investing, that will be get invested in various sectors of the economy which will help in the overall economic growth. Now just putting the money under the mattress is not going to help because neither will it generate any return for the individuals or institutions, nor will it promote economic growth. So capital markets will ensure that your funds get directed in the right project activities. Then fueling of economic growth. So firstly, jobs creation. So jobs are important for any economy. So if you read any economic research report, every report talks about jobs growth. Jobs growth because whenever individuals are working in their respective jobs, they are contributing to the economy in some way or the other. Now, a well functioning capital markets can support that activity because that will ensure that funds are getting directed in the right projects, which will create employment opportunities for individuals. Also, building infrastructure, that can be another activity which capital markets support. So imagine that there is a large infrastructure project in a certain city. So let's say a bridge has to be constructed across a river. So that's a long-term infrastructure project for that particular part of the country. So it will require long-term funding as well. So generally, these type of projects are funded through long-term bonds. So investors will invest money in the bonds today, and in a few years' time, once the bridge is completed, and when it starts generating the revenue income through fee receipts or the receipts from the toll income which it receives from motorists, that will be used for paying off the cash flows on these particular bonds. So such type of bonds also exist in the market, and they are raised through a well-functioning capital market. Now, funding financial innovation. So financial innovation is a must. So over the years, as the market evolves, we see more and more financial products and more sophisticated techniques being used by institutions and market participants in general. So to support those activities, a well-functioning capital market is required because you may have the best possible or a very sophisticated financial product, but if there is no market, that is there are no takers for that product, then it's not worth it. So you need a well functioning capital market to support financial innovation. Now when we talk of these markets, we talk of an ecosystem which is a combination of a few entities. So we have buyers, sellers, financial intermediaries, the capital market itself, and the regulators. Now, let's try to understand what are primary and secondary markets. So these are the main sections in any capital markets in any country. So starting with primary markets are that place where a product is introduced for the very first time. So until then, the market doesn't know such product exists. So whenever a company has to raise, say, a fresh bond or maybe equity IPOs, they happen in the primary market. That's because you're introducing that particular issue or a product for the very first time. So a few purposes with primary market meets are firstly price discovery. So whenever we are introducing something new to the market, we would like to know how much that product is worth. So yes, you will have very sophisticated models which you will build for estimating what is the price of a certain product. So let's say your product, your model throws a price of say 85 on a face value of 100. But once you introduce the product to the market may feel that the product is just worth 80. That way, a primary market will help you validate the price of a certain product. Then channeling of funds. So whenever there's a new IPO coming in or a new auction of securities happening, then you'll see that interested parties will invest their funds in those products. So that will help in channeling of funds into the capital market. And it gives an idea of expectations on future yields. So yields happen to be a very, very important component for not just banks, but for other financial institutions as well, because yield curves are going to define what your cost of borrowing or lending is going to be in the times to come. So this kind of analysis is important, and primary market provides a guidance on that as well. Now coming to secondary markets, so the products which have been introduced in the primary market, once they are now secondary market is going to provide an avenue for trading of these products. So one simple example of a product which gets transacted in the primary market. Now we know that any sovereign government requires funding for various activities. So it could be public welfare or government expenditure, etc. So for that, they raise money from the public, and that is done by the central bank of that country. So if we focus on the Indian context, we know that the Reserve Bank of India conducts periodic auction of government securities in order to raise funds for the government of India. So this is what happens in a primary market, because the RBI is issuing those bonds for the very first time. So they have to be done in the primary market. And once these bonds have been issued, then the actual trading or the transactions on those bonds will happen in the secondary market. And now let's try to understand how the secondary market functions. So secondary market is there to as a natural progression of the primary market. So something which has already been introduced should be given opportunities to trade. So that's what happens in the secondary market space. So a few purposes which secondary markets support. Firstly, trading opportunities. So it could be for financial institutions, banks, individuals, etc. Also, it gives a good amount of idea as to the financial condition of certain companies or the market as a whole. So many of us track equity markets very, very closely. So looking at the stock price movements of a certain company, we generally get some bit of idea as to where that company is headed financially. Also, if we are to look at a market as a whole, then we can look at any broad market index. So again, sticking to the Indian context, if we look at a Nifty 50 index, which is a popular broad market index, that gives us an idea as to where the overall equity markets are heading. So that's an important input from trading as well as from a risk management perspective. And secondary market also provides pointers on the interest rate scenario in the economy. So yes, via primary markets, we get to know what the yields are or what the yields are expected to go ahead with. However, in the secondary market where actual trades are happening, so that is a place where demand and supply is going to impact the yield curves and the shape of yield curves in general. So having an active secondary market helps us understand that how the interest rates are going to pan out in the future. So that can help banks take on certain decisions as to what could be their deposit rates or what could be the rates at which they'll be lending, or even things like what could be the rate on their fixed deposits, or companies could try to figure out what could be their potential cost of capital going ahead. So all of these things uh, we'll be able to procure if we have a well functioning secondary market. Now popular products include already issued bonds. So going back to our example, so the bonds which have been issued by the RBI, once they start transacting in the secondary market, then these are the already issued bonds which we have listed here. And next is equity shares. So imagine that a certain equity was introduced as a part of IPO in the primary markets. So recently, again, sticking to the Indian markets, Indigo Paints was a popular IPO which had come in. So once Indigo Paints was introduced in the primary market, whatever subsequent trades happen, they happen in the secondary market. Now let's try to understand bonds and their main features. So answering the question, what are bonds? So a very, very simple example of a bond is a fixed deposit. So imagine that I have 100 rupees with me, and I want to invest that in a very, very safe instrument. So I will approach a bank, and let's say the bank is offering fixed deposits of 1 year. So I'll invest those 100 rupees in the fixed deposit for a 1 year's time, and the bank will pay me a certain interest. Let's say the FD rate is 5%. So investing the money today, in 1 year's time, I'm going to receive 105 rupees back from that particular FD. So that's the most simplest form of a bond. But bond is different. Simple example of a bond can be a what we call as a plain vanilla bond. So the plain vanilla bond has been structured in such a way that, let's say I'm an investor, I purchase the bond today, and over the bond's life, I am going to receive a certain periodic coupon, which is the coupon interest, and at maturity, I'll be receiving the face value of the bond. That is, I'm getting back the investment which I've done in the bond. So that's like the basic mechanism for a bond. Now, why do market participants transact in bonds? So there are a variety of reasons. So one could be trading. Other could be long-term investments. Third could be funding. Fourth could be regulatory requirements. So let's quickly run through these 4 points. So when we say trading, so these are the trading actions which are done by traders. So it could be either bank traders or traders at large financial institutions. Then companies also invest in bonds from a long-term perspective. So they may have a certain long-term strategic goal which they wish to achieve through a certain investment. So bonds provide an avenue for that as well. Then funding. So we know that for any company to work, they require capital. So when we say capital, we can also call that as the funding which the company is doing. So funding can be a composition of equity and debt. So when we say debt, that is equivalent to saying it's the bond capital which the company is raising. So whenever the company issues bonds for raising capital, we say that it's raising debt capital from the market. So that's the funding point. And coming on to regulatory point, so banks have a requirement that they need to park certain amount of their funds in government securities. So that's the regulatory requirement which banks have to satisfy. So that's the point pertaining to regulations around investments in bonds. Next, moving on to composition of bond markets. So when we talk of bond markets, we divide them into two parts. One is the sovereign bond market and other is the non-sovereign. So sovereign bonds are also what we call as SLR bonds, and non-sovereign is what we call as non-SLR bonds. So focusing on the SLR variety, so SLR bonds are those which are issued by sovereign governments. So the idea behind sovereign bonds is these are backed by the full faith of the sovereign government of a country. And when we talk of non-sovereign, these could be bonds which are issued by companies, banks, large financial institutions, etc. So anything which is non-government in nature, it gets classified under as a non-sovereign bond. Now moving on to a few bond features. So firstly, starting with the issuer. So we know that issuer can be a government or a non-government entity. So adding to that, there can also be bonds which are issued by certain states. So you can have state development loans which individual states are issuing. So these are essentially bonds which are issued by state governments for funding various welfare or government expenditure of that particular state. Next is classifying the bond based on maturity date or coupon. So you can have a bond which pays out a fixed coupon, or you could have a bond which pays out floating coupon, or your coupon could have a step up and step down. So that can be another variety. Next, you can also classify bonds based on the maturity date. So you can have, say, a bond with a fixed maturity, or you could have a bond which is perpetual in nature, so which doesn't have a maturity. Next is based on the par value. So when we say par value of a bond, let's take a simple example. So imagine that the face value of my bond is 100 units. And let's write three prices. So 100, 95, and 105. So when the bond is trading at a price of 100, we say that the bond is trading at par. Whenever the bond is trading at a price below 100, we say it is trading below par or it's trading at a discount. And whenever the bond is trading at a price which is higher than the face value or above par, we say it's trading at a premium. Next is coupon payment and frequency. So you can have a plain vanilla bond which pays out periodic coupons, which could be either quarterly, semi-annually, monthly, annually, etc. Or it could be a zero coupon bond which doesn't pay any coupon. So you invest the money today and you finally receive a one-shot payment in the end. There are no intermediate cash flows. So that's how you can classify based on coupon payments and frequencies. Now let's try to understand basics of bond pricing. So before we understand the formula for bond pricing, let's try to understand why banks require to price bonds. So when we say banks, you can also say other financial institutions or corporates. So let's try to address the why portion first. So once we are clear with the why portion, then we can move on to the how portion. So how is the actual approach which we'll understand of how bonds are priced. So let's try to understand a few points why this pricing is a requirement. So first is portfolio valuation. So be it a trader, a fund manager or an investor, they would like to know how much their portfolio is worth. Because when we talk of a portfolio, which is the financial portfolio, we are investing our money in certain assets and we would like to know how those assets are doing. So what the position of those assets is can be understood through what we call as portfolio valuation. This is also called as the MTMing of your portfolio. Next is capital adequacy. So we know that banks have to satisfy capital adequacy requirements. So these are regulatory requirements, and the idea behind capital adequacy is to ensure that the bank is sufficiently funded so that even in terms of market stress, a bank can still continue to be liquid and continue to function properly without running to the regulator for help. Next is risk management. Yes. So when we talk of any risk management application, so let's say I'm doing something like limits monitoring, then so let's try to combine risk with limits monitoring. So one of the common examples of why we require bond pricing within risk, first is could be for limits monitoring as we have mentioned here. So there are certain specific limits which are defined on every portfolio. So these are, you can imagine as thresholds which have been set from an organization policy and they will be plugged in into your system and those limits will be tracked real time. So maybe there could be an MTM limit which has been fixed and that will be tracked on a real time basis. Next is in risk, we also do what we call as exposure monitoring. So that is another function which risk does. So exposure monitoring basically explains how much is our exposure to a certain counterparty. So that's where valuation gets used again. Next is provisioning for illiquidity, because why we require this provisioning is because not every single bond is liquid enough. So you can imagine illiquidity is something which can manifest as a price hit which one has to take whenever we are transacting a certain bond. So let's imagine two bonds. So let's say one is a government security and let's say other bond is a certain non-SLR bond which is very thinly traded. Now, if I have to transact bond A, which is the government security, which is liquid, then it's easy for me. So there is no illiquidity associated because there are multiple takers in the market who would be willing to purchase that bond from me. So offloading that position is easy relatively. Whereas if you contrast this with a non-SLR bond, which is very thinly traded, then offloading that bond is going to be difficult because there are not too many parties who are interested in holding those bonds on their books. So one may have to take a price hit, which we call as illiquidity for that particular bond. And banks have to do some bit of provisioning for that illiquidity. So to arrive at how much is the capital provisioning to be done for illiquidity, the bond pricing is required. So these are a few reasons why banks need to do bond pricing on a day-to-day basis. Now let's understand the how part. That is, how do you price a bond? So I'll write a very simple formula and then we try to understand that formula as well as the meaning of YTM. So imagine that this bond has a maturity of 2 years and the coupon frequency is annual. So this means the bond is going to pay out coupon at the end of the first year and again at the end of second year. And also at the end of second year, the bond will mature. So the face value will also be returned to the investor. So the formula which I've written on the right hand side, this is what we call as the bond pricing formula, where C is my coupon and FV is the face value. Now, when we say we are pricing bonds, it's nothing but we are summing up the present values of our future cash flows. So this is my cash flow 1 and this is my cash flow 2. Now, to be more precise, this is PV of my cash flow 1 and PV of my cash flow 2. So why I say this is a present value? Because when I'm including the term 1 plus y in the denominator, this is what I call as the discounting term which I'm using in my calculation. So just taking a step back, we have the formula for time value of money, which we have FV is equal to PV into 1 plus R raised to T. So FV is the future value, PV is the present value of an asset, and R is the relevant interest rate, and T is my time to maturity. So if I simply rearrange this equation, I have PV is equal to FV upon 1 plus R raised to T. So here you see the similarity between this equation and let's say cash flow 1. So if I just substitute FV as C and 1 plus R raised to T as 1 plus Y raised to 1, what I'm essentially doing is I'm trying to calculate what is the present value of my future cash flow, because the first cash flow is occurring at the 1 year time point and the second cash flow is occurring at 2 year time point. So when I'm discounting, I'm trying to calculate how much that cash flow is worth today. So that is present valuing something. So once I have present values of my individual cash flows, I simply sum them up and I have my bond price. Now coming to what we call as YTM. So YTM is an acronym for yield to maturity. So going to our formula, you see there is a Y in the denominator. So this is what we call as the bond YTM. So you can imagine YTM is the yield which an investor is going to earn on this bond. That being said, there are a couple of assumptions or a couple of conditions which have to be satisfied in order for an investor to earn YTM. So firstly, the bond has to be held till maturity, and also all the periodic coupons have to be reinvested at the YTM rate. So that will ensure that the investor is going to earn the YTM till bond maturity. Now, understanding the relationship between price and yields. So the relationship is an inverse. So bond price is inversely proportional to yield. So that can be also seen from the formula right here. So if my yields increase, that means I am dividing by a higher number in the denominator. So when I am dividing by a higher number in the denominator, the present values of my cash flows are going to come down. So finally, the bond price is going to drop. Now imagine a scenario where yields are dropping. So if yields fall, that means I'm dividing by a lower denominator. So that implies that my individual cash flow numbers are going to go up. So my bond price goes up. So here we see that the relationship which is inverse is in sync with the formula which we have written. So if we are to plot the price versus yield chart, it looks something like this. We have the bond price on the y-axis and the yields on the x-axis. Now there is what we call as a credit risk which is embedded in bonds. Now for government securities or SLR bonds in general, that problem is not there, because whenever you have a bond which is backed by the central government, then the central government won't default on their payments. So there is no credit risk for SLR bonds. However, for non-SLR securities, credit risk is definitely a concern. Imagine that a certain bond has been issued by a certain company. So the idea is the company is going to do its business, generate the required revenues, and those are going to help the company pay out the required commitments on the bonds. Now, there's a chance that the company's business model has a few flaws, or maybe it's running into a few problems. So if it runs into problems and revenue generation is a problem, then that jeopardizes the way in which the company is going to honor its commitments on the bonds. So that is what we call as the credit risk which is embedded in the bond. And that can manifest itself as the company defaulting on a few payments that is the few coupon payments on the bonds, or defaulting entirely, that is the bond that it's unable to honor uh, both the interest as well as the final face value on the bond. So in order to account for credit risk which is embedded in the bond, an easy way is to adjust for spreads. So spreads are also called as credit spreads. So one small modification has to be done to our bond pricing relation. So just rewriting the relation once again with the spread adjustment, I adjust my denominator for the relevant spread. So here you see I have written a small s in the denominator. So S is used to depict the credit spread which is inherent in the bond. So naturally, after adjusting for credit spread, the bond price will come down because I am adding a term in the denominator. And when I do that, my overall bond price is going to come down. So that is the way in which we are trying to factor in the credit risk which is embedded in a certain security. So to know more about bond markets and to discuss a few more interesting concepts pertaining to fixed income, do sign up for our certificate course on fundamentals of bond markets.